Okay, let's get started, shall we? Hello and welcome to this Lexology webinar. My name is Jeremy White. I'm an editor here at Lexology. Thank you very much for taking time out of your day to join us. Today we are looking at structuring African business to ensure maximum efficiency and minimal risk. We've got a really good presentation lined up for you today. We're looking at a number of structures available to foreign investors that minimize the risk of investing in Africa and the pros and cons of each and much else aside. So I think you'll get a lot out of it. Our expert speaker today is Deepa Vallabh. She is a director at Cliff Decker Hoffmeyer's corporate and commercial practice, where she heads the cross-border M&A group for Africa and Asia. She has a very wide array of legal specialties, including M&A, competition law, structured finance, securitizations, and several other things. Before I hand it over to her, I'd like to point out a few technical considerations for attendees to bear in mind. First and foremost, if you have any questions during the presentation, please do use the online Q&A tool to send those to us. And at the end of Deepa's presentation, I will pose those questions to her. Secondly, if you have any audiovisual problems throughout, please use that Q&A tool to let us know about them, and we'll try our best to sort them out. And third and finally, this is a heads up that afterwards you will receive a link to the recorded version of this webinar, complete with the slides. So do keep a lookout for it and pass it on to any colleagues who might be interested. So having said all that, I will now hand it over to Deepa to get us started.
Good afternoon, everybody. This webinar is meant to give you a broad and yet also quite specific view on some of the structuring options that are available in relation to investment into Africa. Before we kind of move on to the more detailed focus areas, I think what we'd like is just to give you an outline of what you can expect from today's webinar. So firstly, we're going to do a bit of an overview of the risk and rewards in investing in Africa. And I think that in relation to this, there are some general trends that, most people would already be aware of, but this is just to contextualize the discussion that follows. So we will touch on the overview of risks and rewards. We'll also give you an overview of the structures that are available to foreign investors before we start looking at an in-depth look in relation to these structures and how do we minimize risk and increase efficiencies in each of them. But most importantly, also, what are the considerations in relation to these structures that may be important for each commercial, endeavor? And then lastly, we'll just touch on the local ownership requirements in certain sectors and what does that mean for governance, in particular, what does it mean for foreign investment across Africa? I think it's a theme that we've seen growing over the last few years, and it's quite important to keep at the back of your mind when you are actually looking at certain investments. So perhaps if we can just then move on to the risk and rewards of investing in Africa, just looking at the overview, I think everybody is aware that Africa is alive with investment possibility, but that there are, risks associated with that investment. So perhaps looking at, and I'm sure a lot of you have seen this, but the sort of dialogue around the potential in Africa has evolved over the last 2 decades, from, being the hopeless continent to the rising continent to the aspiring Africa. And The Economist hasn't done a recent one, but I think you'd find that we've moved and leaped from aspiring to growing Africa. So kind of looking maybe then at what are the potential risks that investors are facing on a daily basis in relation to making some of these investment decisions. The first and foremost, and I think this is probably something that is that most people are aware of, is the political and social instability in various jurisdictions. But again, we need to kind of contextualize that Africa is a continent of many countries, and certain regional conflicts are more rife than others in certain areas. Corruption indexes will give you an indication of which countries, face a larger systemic issue around corruption. Lack of policy is also an issue that, is not often well met by sophisticated investors who are looking to find a grounded governance structure for them to act.
We're doing everything we can. Just sit tight, everyone, and we'll get everything fixed very soon. Very sorry. Okay, thank you very much for bearing with us. Deepa's going to dial out and then dial back in. Hopefully that should remedy. I think we can get the show back on the road. Apologies, everyone.
No hassle. It's good to see that we still have these problems in the first world countries. Okay, so I don't know where I left off last, but I'm going to just continue with the discussion around some of the risk profiles or the risks in relation to investing into Africa. So we touched on political and social instability, moving on to lack of infrastructure being one of the issues that, you know, investors are continually concerned with. And many countries in Africa still require a substantial amount of capital in order to build on large infrastructure projects that relate to roads, electricity, internet, and other sort of port and rail and logistic infrastructures. That the development around infrastructure is happening at a rapid pace, but not rapid enough, and it's one of the barriers, you know, relating to investment on the continent. We also then have a number of regulatory barriers. What we've seen, particularly in the African regulatory framework over the last 6 to 7 years, and in some jurisdictions probably more recent, like the last 2 to 3 years, where there has been a rapid revolution around the regulatory frameworks of many jurisdictions which have not updated their regulation or legislation for a long period of time. Some of the new regulatory frameworks in certain jurisdictions make it quite difficult to navigate because they remain untested, and there is uncertainty around how to implement some of the policies that underpin the regulation and the new regulation that we're seeing. There's particularly a increase in regulation around local ownership requirements, and I think I'll touch on that more specifically towards the end of the seminar. But just to bear in mind that that is becoming an increasingly difficult barrier for many investors. We then have, you know, education and skilled labor gaps, and depending on where you are in Africa, these are more pronounced or less pronounced. So, for example, you know, South Africa does have a very skilled workforce, high level of education. Similarly, in Kenya, we've seen an increased capacity in terms of schools, universities, and program around education and skilling of labor. But in certain areas, we still find that there is a significant lack of and a gap relating to the skill and education required in these markets. I think having touched on the risks, you know, let us look at what's the upside in investing in Africa. They are, you know, obviously, as the patterns show in the last couple of years, there's still been an increased appetite for investing in Africa, and there must be, you know, good logical reasons why Africa still is a continent that promises a great opportunity from an investment perspective. And some of the benefits and the rewards are summarized in the next couple of slides. Firstly, there's very high returns. So according to, you know, the Overseas Private Investment Corporation and the UN Conference on Trade and Development, Africa offers the highest return on direct foreign investment in the world. And this is something that you can't ignore in where you've got contrasting markets around the world that either don't give you as high a return or, you know, returns are pretty stagnant. There's also rapid urbanization across Africa and across different pockets in different developing countries. and it will continue to remain the world's fastest urbanizing region. There's increased household consumption. The expected household consumption growth is about 3.8% a year, and is projected to reach about 2.1 trillion by 2025. And it also has the potential to double its manufacturing output quite significantly by the year 2025. So those are two very, very important, considerations not to ignore investment on the continent. We also then have a significant population on the continent, which represents about 14.7% of the total world population. And by contrast, the projections show that we will have a larger working force than China and India by the year 2034. There is a inexpensive labor force as opposed to cheap labor force. That's the correction from my side. And over 40% of Africans belong to or will belong to an upper or middle class segment, which again means that there's a significant amount of consumer spend that can be unlocked in the coming years. Because the region is underdeveloped, it continuously attracts opportunity for investors to find markets and niches, and obviously the growth potential that they're looking, which they can't get in a more developed market where competition is rife in certain sectors. And natural resources still underpin some of the biggest fundamentals in Africa, which is known for its vast and rich natural resources. So we still find that the fundamentals around natural resources work in favor of the continent, with a large proportion of the world's reserves and minerals still sitting on the continent. Okay. I think that's just to point the last two sort of positive fundamentals that are working in favor of Africa being the investment jurisdiction is the growth rate, and particularly the growth rate in the past 4 to 5 years has shown that there has been a significant amount of growth in a lot of these regions, some as high as 13% over the last few years, but with an average kind of expected of about 3.6% between the year 2019 and 2020. So that's the coming financial year. And then there is a significant improvement in progressing the African Continental Trade Agreement or Free Trade Agreement. This has been on the agenda of the African Union members for a number of years, but 52 out of 55 African Union members are now signatories to the African Continental Free Trade Agreement, which is meant to encourage intertrade between Africa, and particularly to fuel investor confidence, to ensure that there's a multi-jurisdictional approach in relation to certain investment opportunities, and also to encourage growth between member states. So moving on to the structures and options available to investors. Just a pause there, Jeremy. I don't know if we should take any questions now. Should we leave all of them for a little later in the presentation?
We don't have any questions yet, so I suppose we can kind of monitor the situation as we go along. That's okay, all right.
Great. Yeah, that's perfect. So I think, looking into the structures and the options available to investors, generally African M&A transactions can be relatively complex, depending on what we'd like to achieve from an investor perspective. Also depending on whether or not there are multi-jurisdictional factors that need to be considered in relation to a particular investment. So typically what we find is that there are some unique agreements and arrangements between the parties due to the cultural nuances and political nuances which are quite different from the West. And these need to be factored into consideration when negotiating with local investors in these regions. There are also very country-specific regulatory approvals which may lead some difficulties if they're not correctly understood. And I think just as general considerations before we move on to the more detail around each of the structures, the options in terms of how to acquire assets in Africa or how to acquire businesses in Africa are no different to the options available in, the more developed jurisdictions. I mean, essentially, you still have, from an M&A perspective, a mix of either an equity purchase, asset purchase, a merger, or, a fresh incorporation if it's a business that is starting anew. However, the considerations around which one or which of these to actually pursue depend largely on some, normal factors that you would take into account in any M&A transaction, which, refer to either financing considerations, tax considerations, business continuity considerations, etc. But there are certain different nuances in relation to structuring in Africa, which needs to be considered in relation to, for example, warranties and indemnities. There's normally a standard list that, we would apply in a normal M&A transaction. Whereas in Africa, the warranties and indemnities need to be questioned around whether or not they'll be enforceable, and the enforceability around what those warranties and indemnities are worth on paper versus whether if you had to actually enforce them, whether there's any muscle behind it. Limiting liability is another area which needs to be carefully considered. Price consideration, often currency fluctuations and exchange control requirements around these things need to be factored in. It normally affects pricing. It normally affects timing. Business continuity, which means the period between signing and actual implementation may be a lot longer than in a normal M&A transaction, given that the regulatory framework in many of these jurisdictions can actually be quite a hindrance to making sure that we get to completion in a timeless manner. And then there's certain things like key contracts, security and employees. Key contracts, for example, one of the difficulties in evaluating and considering value of local businesses that you purchase is actually a lack of certain formal contracts that are in place between that business and its key customers. And often that is something that needs to be factored into how the entire deal is structured. Similarly, security and what security can be taken would also need to be considered very, very carefully. And from an employee perspective, there's sort of nuanced considerations in different jurisdictions. For example, in South Africa, you've got an automatic transfer of employees around a business sale, with certain important considerations from the labor relations perspective, which increases liability when you're actually acquiring a business. Very similar considerations are relevant in certain other African jurisdictions, for example, in Zambia, where there is a strong labor slant towards protecting labor in businesses, and similar considerations in Kenya. So it really depends on where you're actually trying to structure a business, and these issues become a lot more complex if you're doing a multi-jurisdictional type of transaction where you would need to actually deal with each jurisdiction quite differently. So the nub of these considerations are really for guidance purposes to make sure that all of these factors are actually being considered when you are structuring an investment into Africa. One of the key structuring vehicles that we've seen work very well in Africa and continues to be the more common route in terms of certain investment opportunities are joint ventures. And we'll go into some very detailed discussions around the different types of joint ventures and what the advantages and disadvantages of these joint ventures are. But the reason for actually participating in a joint venture, regardless of the form of it, is that it's becoming an increasing trend to invest in Africa with a local partner, or to have the exiting majority shareholder retain a minority or a certain percentage stake in the business. And this is key for continuity, but it's also relevant for ensuring that there is sufficient ability for local penetration of that business, together with sufficient comfort that you have a local partner who understands the environment and is guiding the business into the sort of next phase. So JV structures have their importance, not just from a structuring perspective, but it has quite a key importance in relation to ensuring maximum benefit of that investment in a particular jurisdiction, given the nuances of working in various regions, and given that local ownership participation can actually be the key to unlocking the investment potential in some of these regions. So now let's just maybe look at the in-depth pros and cons of the structures available to investors. And just a summary, as I alluded to in terms of the considerations on the different stages of an M&A transaction. I think the very first leg is that we actually need to understand the strategy as to why we're investing. The why is very important. We need to test the how, and we need to ensure that, you know, the investment actually has the commercial fundamentals that are required for growth. The preliminary process is very important in any decision to actually invest across the continent. And the preliminary process actually involves more than just your standard due diligence investigation. It actually involves a diligence in relation to the partners that you are speaking to. It involves a diligence around the regulatory framework of the jurisdiction, and a very deep analysis of the sector and the sector potentials in relation to the particular sector that you want to invest in. And this almost, you know, it needs to be more than a desktop exercise. It needs to be an exercise that is supplemented by the desktop information if there is any available. But more importantly, it actually requires the deal teams and the investment teams of a particular investor to actually spend time in the particular jurisdiction and try and understand the nuances and the fundamentals in a bit more detail. And what we find is that those investors that do that at the outset, before they actually start discussions of how to take the investment proposal further, are better equipped than those that do it either during or even after they've made the investment decision. The next phase is obviously your due diligence, which, you know, which include the standard due diligence checklist that you would do in any M&A transaction. But there are two very important components of a due diligence investigation that may not necessarily be key items if you were looking at an asset or an investment in a developed country. The one is there is a risk due diligence that normally gets conducted, and that could form various, or it could be in different formats. It could be a risk in relation to the actual investment itself. It could also be a risk profiling into the actual individuals behind the company that you are purchasing or behind the investment that you are purchasing. And it also could be a due diligence into the actual management team that is, you know, that has been running the business or may continue running the business into the future. in addition to the risk diligence, there is often a sort of understanding of the corruption profile mapped against the requirements of, of the anti-bribery and corruption legislation which an investor might be subject to. And that is also an important aspect of the diligence investigation that people would need to take into account. Post the diligence phase, is obviously the execution of the transaction, which includes the negotiation, the understanding of the regulatory framework, the various regulatory applications, and the engagement, both with the regulators and with the internal teams of the particular entity that you're purchasing before we get to an integration phase. So execution of transaction could be a lengthy phase in some jurisdictions because of regulatory controls, could be up to 18 months, depending on the sector that you're investing in, depending on the licenses that are required or the approvals that are required. And then you have obviously the integration phase, which is meant to bring all of the prior steps, into effect. But it's really where the hard work starts in trying to translate the investment into the potential that you've seen at the strategic stage. So just moving on, these are some of the considerations that I think you would need to consider from a deal structuring perspective. The heads of agreement or memorandum of understanding is generally, in some deals it's good to have, because you want to lock a party into negotiations. In some deals, it's not often necessary. In Africa, and in particularly in our experience, heads of agreement or memorandum of understanding is actually a really good start in terms of having the discussions on in terms of how the deal will unfold. And this is for several reasons. The first and foremost reason is that in some markets, lengthy agreements and detailed documents are not the way certain investors do business. And, to have the initial discussions and then following it on with voluminous agreements may often, put a stop to the discussions and delay the transaction further. So to test the appetite of the party that you're negotiating with, it is quite important to perhaps start documenting the fundamentals and the essentials of a deal under a heads of agreement or a memorandum of understanding. And it's really important that this becomes a sort of guiding document around fundamentals of purchase price, payment, structure of the deal, what are some of the conditions, confidentiality, and most importantly, a commitment, a written commitment not to speak to other investors during this period. An NDA is often a standard provision or sort of standard document that you would enter into on any transaction, and it should be no different in Africa. Moving on, I think we've discussed the due diligence. This is just a checklist in terms of what you would need to consider in the due diligence phase. We would look at legal, tax, accounting, forensics, again, corruption diligences, and there are agencies that actually do some of these bespoke investigations. Typically, all of these findings will be put together in a report, and this is something that will inform the fundamentals for your investment committee and also form the basis of certain warranties and indemnity discussions and price discussions, more importantly, in a particular transaction. Some of the additional considerations around deals is, as I've indicated earlier, merger control is a new phenomenon or fairly new phenomenon in some of the markets and some of the jurisdictions in Africa. There's certain countries that still don't have any merger regulations, for example, Egypt. In certain countries, no approval has absolutely no impact, but there may be certain penalties that do attract non-compliance. And in some countries, there is a very complicated merger control regime where you have both a local requirement to apply for merger control approval within a particular country, for example, in Kenya, and then you also have a regional body that looks at East Africa, for example, in general. So you would have to make two filings. You'd have to make a local filing, and then you would have to make a regional filing. And that can complicate both timing considerations for merger approval, but also cost implications in relation to merger control approval. So it's really important to understand the regulatory regime of merger control in different regions. In some jurisdictions, for example, in South Africa, we have a very well-developed merger control or competition law framework, which kind of is modeled on international best practice, with merger control being triggered, through different thresholds. In some regions in Africa, you don't even need a threshold before merger control is actually triggered. You just need an investment from a foreign entity. So these issues need to be looked at very, very carefully. Similarly, exchange control is a concern in certain regions because it does restrict the amount of currency inflow and outflow. It also means that there is a timing implication in relation to getting approval for the investment. And you often have to deal with very complex discussions and negotiations with certain central banks, depending on the value of the investment. So that is an important factor to consider from a timing perspective. And then there's sector regulation-specific legislation that you would need to consider. For example, telecoms is a very regulated sector across Africa. So is media. So is mining. And each of these sectors have their own regulation and legislation in place which requires compliance. Okay, so moving on, I think we've dealt with execution, which really relates to the drafting, negotiation, and signing of the agreement, CP management, closing and implementation, and then the post-closing phase. And then integration really means the business integration, the commercial integration that happens post the transaction becoming unconditional. Yes, we've dealt with purchase of shares, purchase of assets, or mergers. Again, these are just three variations of how you could potentially invest in a particular region. The fourth one, which is not mentioned here, is really a fresh investment in any jurisdiction, which doesn't require purchase of shares or assets or merger with an existing business, but is a fresh startup and incorporation of an entity. We see this type of investment less and less, in different markets, and largely because of the complexity in relation to some of these investments. There has been a preferred route towards investing or co-investing with local partners. I think, if we can now move on to just some of the advantages and the disadvantages of joint venture arrangements, and the reason why there is a slight focus in this presentation on joint ventures is because, as I said earlier, joint venture arrangements seem to be the key structures, when entering African markets. And this is not always the case. So, this is not a script for how it's always done in Africa, but it's certainly a significant. It certainly has shown a significant trend upwards, and particularly in the markets that we've been advising in. So JV arrangements are attractive because they can also be more informal. So there are easier exit mechanisms for foreign investors in some of these structures. They also allow for governance to happen via agreement, which allows you to put the principles that you're looking or seeking in terms of how you want the company to run and what governance structures you want that to, what kind of governance structures you want behind that. You could regulate this from a legal perspective, and I mean essentially this allows you for some form of flexibility of either increasing your investment over time, which means increasing your exposure over time once you get a better understanding of the market, or conversely exiting the investment with minimum impact for the foreign investor. So there's sort of three common forms of joint venture structures that we've used and we've advised on, and each obviously has its pro and cons. So firstly, looking at your private joint venture companies, the advantage of a private joint venture is that it has a separate legal personality, so it forms it is an incorporated entity in which you and a local shareholder or foreign shareholder and a local shareholder will participate, depending on how you want the investment profile to look, whether it's a JV, which is 50% or 75-25, or a variation of that. It has limited liability. They generally is perpetual succession, so no different to a limited liability company anywhere else in the world. Your directors are not your shareholders and are generally responsible for running the company's activity. The operating capital can be provided by way of shareholder loans. The shareholder loans, as opposed to equity, do generally afford greater flexibility in relation to gearing and leveraging of the company. Typically, on a private joint venture company, directors owe a fiduciary duty to the company and must act in the interest of the company, not the shareholders. There are other juristic persons, which can be obviously shareholders in these private companies, so you don't have to own the shares through a natural person. And the incorporation of private companies is relatively simple, but some jurisdictions do have longer lead times. But effectively, most African jurisdictions now, you could achieve incorporation within a week, some shorter. There are some jurisdictions that still have a very lengthy registration process, but these are the gap between what can be achieved in a developed market versus an African market, I think is shortening. Some of the disadvantages of private joint venture companies: it's obviously governed by legislation, so there's less flexibility and there's more stringent regulation, so you would need to actually form the company in terms of the local Companies Act in a particular market. There is restriction on transferability of shares. You can't actually make offers to the public because it's a private company. You may be required, if you have certain thresholds or you meet certain revenue thresholds or turnover thresholds in the company, to prepare audited annual financial statements and not just annual financial statements. Some of the administration of these companies can be very cumbersome and must be done through the company's or equivalent regulatory body. So, for example, in some jurisdictions, there is quite there's quite an extensive requirement to file everything with the company's office. So, apart from your normal director changes or your MOI, etc., there's requirements to file every change in your capital, for example, with the company's office. Every time you make a change in terms of your auditors or your accountants that you use, there's a requirement to file. And in certain jurisdictions, this is important for people to understand the nuances, because in certain markets, certain actions are not effective or doesn't have any implementation effect until a regulator actually approves it. So these nuances or differences are really, really important to consider when running a private joint venture. Some of the other disadvantages that you do have to have a regulated shareholders agreement, and you do have creditors that take preference in a liquidation scenario of a private company, as opposed to or ranking ahead of your equity holders. And then, depending on the jurisdictions, your director's duties and responsibilities can vary, and there can be personal liability for certain directors in certain instances. Okay, then moving on to joint venture partnerships. There are, structures which doesn't require or rather a partnership can be formed by agreement, which does not require any incorporation or any formality in terms of incorporating the partnership. It's flexible. It's normally not governed by statute, so you've got the common law principles of partnership that govern it. And again, this can be negotiated rather than being defined by a particular framework of legislation, and there's no registration requirements for general partnerships. The disadvantage is obviously that it doesn't have any particular separate legal personality, which means each partner makes a contribution to the partners, and they get taxed individually in relation to their own personal affairs. There's also a risk that the liability for debt is joint and several, where you could potentially have one partner picking up the liability of another partner because of the joint and several element to it. And whenever the partners change, effectively due to death, insolvency, or otherwise, the partnership terminates. So there's no perpetual succession to a partnership model. We've also seen very akin to a partnership is an unincorporated joint venture. Very similar to partnership principles, it's, two entities coming together forming an unincorporated joint venture, which effectively means that it can be dissolved, can be dissolved very quickly. Once again, the unincorporated joint ventures have certain disadvantages, which could lead to joint and several liability relating to the particular partners that actually make up this joint venture. And you would need to govern quite detailed provisions relating to how this unincorporated joint venture will be managed, from funding to its day-to-day affairs, how the assets and liabilities will be dealt with, the sharing of skill, knowledge, background, etc. Often these unincorporated joint ventures are not that attractive because of the lack of regulatory governance behind these structures, but are very often used, particularly in the mining industry and particularly in the resource space, where these ventures come together for a certain period of time and generally either evolve into incorporated structures or dissolve once, for example, a particular phase of let's say, an exploration phase has been completed, or a feasibility phase has been completed. And it's often not in the interest of the parties to form an incorporated venture with the two partners, but rather some sort of a looser arrangement like an unincorporated joint venture. Now, just to touch on the last bit, which deals with the local ownership requirements. As I indicated earlier in my presentation, that there is a trend in Africa, particularly in certain sectors, for there to be a local ownership requirement in order for a foreign investor to invest in a particular space, or for a foreign investor to qualify for a license to operate in that particular space or sector. These are just some examples. This is not an exhaustive list of what some of the ownership requirements are. And before we look into that, I think it's important to contextualize where this comes from and why many of the sort of governments are actually moving in the space where local ownership is actually becoming such a key element around any investment proposition. Generally, this is to encourage economic participation by the nationals of a particular country. Some of the fundamentals relating to the development challenges in Africa remain the same, and there is a drive, in particular drive in many of the jurisdictions, in fact, in almost all of them, to ensure that that opportunity is being created for local participation and for local growth and for local economic transformation. And that's really the agenda that has been driving a lot of the requirements in certain of these sectors. Some sectors are the obvious sectors in terms of local participation are, for example, mining or resources, where there is a government agenda or a political and policy agenda in order to ensure that that the land or the minerals is actually shared, and the wealth that comes out of that is shared with the national population or the local population. Some other sectors are a bit more interesting in the sense that, particularly opportunities around telecoms and media and broadcasting, for example, or advertising, where there is substantial opportunity for foreign investors to come in and gain a rapid market share, that there's a requirement from a licensing perspective to include a local company or a local shareholder to ensure that the growth is shared. So this slide and the next slide just gives you some examples in different markets that have ownership requirements. So, for example, in Kenya, you can't be listed unless you own 25% by Kenyan national. In Ghana, for example, you can't hold mineral rights directly, and there are sort of minimum capital requirements for foreigners to own businesses in Ghana. In Nigeria, for example, in the advertising sector, almost 95% of that entity has to be owned by a Nigerian local ownership. There's also minimum share capital requirements in some of these. For example, in Nigeria, there's definitely a minimum share capital requirement. In South Africa, the Black Economic Empowerment agenda or the laws have been enforced for some time now. There is an overarching requirement for all sectors to comply with local empowerment, with certain sectors having a mandatory license requirement that requires a local ownership. So, for example, in mining, you require 26% local participation. In the telecom sector, you require similarly around 26%. In the banking sector, you also require a minimum ownership participation. And in Zimbabwe, you have 100% foreign ownership of mining rights, except for platinum and diamonds. Every other mineral cannot actually be foreign owned. So there are nuances and variations to these local ownership requirements, and structuring around these issues are very, very important, and an understanding as to how you can structure around these requirements, is equally important. And so these issues have become very key issues in relation to investment considerations across the continent. It's also become very key issues around structuring entries and exits, and also very key in terms of funding requirements of the business and funding requirements of your local partners in these businesses. So I'm just going to use 2 minutes to summarize some of the salient points, and then I think we can move on to questions. So summary, Africa is still an extremely attractive investment opportunity, but the risks associated with that investment need to be considered very carefully and need to be mitigated. There are numerous structures available for foreign investors, each with their own pros and cons. So it's really important that early and inception of that investment decision process, that these structuring options are considered and taken into account as to whether or not this is an attractive investment proposition going forward. investors must use their time wisely in order to make sure that the diligence is very extensive. And again, the diligence is not a standard diligence. It may be that you require more than the standard diligence. You may need a physical diligence. You may need an interview process. You may need an external agency to vet certain individuals. And so, you know, what is provided by your local entity that you're looking to purchase or invest in may be very insufficient for your normal diligence process that you're accustomed to in other more developed markets. And then obviously, you know, you need to find advice and local counsel advice in relation to investing in Africa to ensure that you understand the framework of that investment, you understand the regulations that govern that sector, and you also understand the local nuances that may be required in your considerations in order for you to make the investment a success. And I think that's me. I'm open to questions at this stage now. Thank you, everybody.
Great, Deepa, thank you so much for that very incisive overview, and thank you for bearing with us on that little technical snafu with the sound. Thank you also to the listeners for sitting tight. To start us off, I was wanting to ask about anti-corruption law because on the Lexology news feed, our white-collar crime strand is one of our most popular, and we've seen an increase in regulation in a lot of countries, like, you know, the recent, there's a new anti-money laundering directive in the EU, for example. I was wondering to get your take on how maybe it's developing in Africa and some of the major jurisdictions, you know, anti-bribery, corruption, anti-money laundering, tax avoidance, kind of, you know, your general overview on how to navigate those issues, both with consideration to the domestic laws and, you know, the laws in other countries.
Sure. I think, Jeremy, it's very difficult to generalize on this topic across the continent. I think some jurisdictions are better than others. So there are definitely national regulations and legislation in place in some key markets, like South Africa has its own national anti-money laundering and prevention of organized crime act. Kenya has their own legislation relating to anti-bribery. So does Nigeria. I think the difficulty with anti-bribery legislation, generally speaking, is the enforcement and the fact that some of the legislation is young or it's in its infancy. You know, enforcement and prosecution under these legislation, I think you'll find very few examples. However, having said that, I think the issue around anti-corruption and bribery, particularly in Africa, is kind of more relates to the extraterritorial reach of, for example, the UK Bribery Act or the FCPA. And when doing a transaction in Africa, you know, with a foreigner who's either incorporates or does business in the UK or the US, how you actually structure that investment to ensure that there is compliance with the UK Bribery Act and you know, the FCPA, I think that is the challenging aspect. But I mean, to answer your question, you know, it's a developing phenomenon across different regions. The execution, or rather the ability to actually get a prosecution under that legislation still remains untested.
Right, of course. Very general question. Sorry to spring that on you, but expertly answered. Do you see potentially with, you know, increasing investment and increasing eyes towards investment, that prosecution increasing in certain jurisdictions over time?
Definitely. I mean, I think that, you know, as the investment, as the number of investments across the region from, you know, from foreign investors increase and no doubt this has been on the agenda for a number of years now. I think the demand to get better governance and the demand to actually hold people accountable to not only the national legislation, but also, to the foreign legislation that may have impact on those businesses, I think is key and is the focus of all the governance discussions around these investments. So absolutely, I think you're going to see an increased requirement for it and an increased, sort of policing around these issues.
Okay, great. Thank you for that. I'm keeping an eye on the clock. I'm trying to make up for a little bit of our lost time. We might have room for one more about merger control regulations. You mentioned that they vary wildly across the continent. I was wondering if you could maybe expand a bit on maybe some of those jurisdictions that have greater notification requirements, maybe what kind of disclosures need to be made and how to go about making those. Sure.
Each jurisdiction again has its own nuances, so it's quite difficult to get into the level of detail that may be required for each particular jurisdiction. But essentially, your merger filing, depending on whether a filing is required, or in some jurisdictions, you need to trigger a certain threshold before filing is required. And then depending on whether it's an intermediate or a large merger, in some jurisdictions they have the distinction, some they don't. There's a significant amount of technical information that needs to be provided, which includes an understanding of the acquiring entity's group, financials related to that, market share information, and then some very important developments that are happening in certain markets, for example, the ability to address policy considerations. So increasingly, our competition authorities are becoming sort of policy overseers to ensure that when a particular foreign investment is coming into the market, that certain common principles or certain economic principles are preserved for local development. So that, they look at the fact that, there's employment and a continuity of employment, so there isn't mass retrenchment, that there is some commitment to development of, employees or suppliers, and that theme is growing. So the level of information that's required for typical competition approval now in some of these markets have actually become quite complex around these policy considerations.
Okay, great. I did have one last. Yeah. No, I think so. I have one last question from an audience member. It's about unincorporated joint ventures. I was wondering if you could expand on the kind of the extent of liability with regard to that. Sorry, I'm trying to read it very quickly. So with unincorporated JVs with unlimited liabilities.
Sure. So generally speaking, your unincorporated JVs will have unlimited liabilities because it doesn't follow a formal structure of an incorporated entity with a board and being regulated by sort of the local company legislation. Essentially what will happen is your unincorporated JV will be a joint and several liability of the partners that form it. They could regulate the liability vis-a-vis each other contractually. So they could try and limit the liability or exposure contractually to their joint venture partner, but they cannot impose the same limitation on a third party. And that's where the difference comes in, is that a third party can actually pierce or look through the unincorporated structure and essentially choose to sue one of the partners for all of the liability. And I think that is an important distinction between an unincorporated structure and an incorporated structure insofar as liability is concerned. So vis-a-vis your partner, you can contractually agree whatever you decide commercially is an acceptable proposition for each of you. But with the third parties, you can't impose that liability.
Okay, great. Thank you for that. I think you've given our listener plenty to chew on with that. Having looked at the clock, I think we're a little bit over, so I think we probably need to leave it there for now. Deepa, thank you so much for that. It was a really, really informative overview of considerations. So to our listeners, just another reminder that you'll be receiving a link to the recorded version of this webinar. So keep a lookout for it and do pass it on to colleagues. Having said that, I will say my final goodbyes and thank you, and I will hand it over to Deepa to say goodbye herself.
Thank you, Jeremy. Thank you, everybody, for participating. If you have any more queries or any questions, and we can facilitate the response to that via Lexology, we'll be very happy to do so. But I appreciate the patience and the time for listening. Thank you very much. Bye-bye.